Hello, my name is Junyi Chang, and today I will be presenting on advanced financial technology with a focus on portfolio management. This presentation will include 5 parts. First of all is the introduction. Based on the content from the website link below and as shown in Figure 1, we can see that the Dow Jones Industrial Average has significant implication for investing in US stocks. Therefore, it is important for us to use the price data in Dow Jones Industrial Average data for prediction and to construct an appropriate portfolio. I'm going to use the data from February 2004 to December 2023. Task 1 is time series analysis. In this task, I need to use 5 stocks from the Dow Jones Industrial Average to predict their mean returns and volatility. First, I will visualize the stock price for these 5 companies. You will see that Microsoft, represented by the green line, has the biggest increase in price. There's also a noticeable drop in 2022, which is due to US interest rate hikes aimed at controlling inflation. As shown in Figure 3, I will use Microsoft as an example to explain the process. First, I selected the dataset I hope to learn from the scenarios like the significant stock decline in 2022. There was a similar situation in 2021 due to the pandemic, so I choose the datasets starting from 2021. I use 80% of the data as the training set and the remaining as the test set. To predict the mean, I used the ARIMA model. After calculating returns from the prices, I use the ADF test to check if the returns are stationary, which they are, making them suitable as input for ARIMA. For selecting the ARIMA parameters, I used an automatic model selection method with HQIC as the criterion, which is a balanced matrix between BIC and AIC, balancing the model fit and the complexity. The resulting values for P and Q are both 1, and since the series is stationary, D is 0. Using the trend models on the test set, rolling forecast achieved an MSE of 1.903, outperforming non-rolling forecast. This indicates that the ARIMA models predict short-term trends well, but its long-term predictions are less reliable. For predicting volatility, I used the gauge model. First, I conducted a white noise test to confirm that the residue didn't display significant autocorrelation, which they didn't, as we expected. Then, using BIC for automatic model selection, both P and Q were determined to be 1. Using the trend gauge model for the predictions on the test set, the rolling forecast green line fits better than the non-rolling forecast, with an MSE of only 0.05. This analysis shows that the gauge model performs well for the short-term volatility predictions, which are more accurate than the mean predictions. This was the entire process for Microsoft in Task 1. The same methodology was applied to the remaining companies. The corresponding model selection and prediction results are shown in Table 1. Now, let's move on Task 2. As shown in Figure 10 and referenced in the link, an appropriate portfolio can efficiently balance risks and rewards for investors. Therefore, it is crucial for us to construct a good portfolio. In this text, I use mean variance optimization to optimize investment portfolio for the 5 companies. I use data from 2016 to 2022 for simulation and test the portfolio with remaining data. This risk return chart shows that Microsoft and JP Morgan have relatively high risks and return, while KO has a more stable returns. It helps to balance risk returns effectively in the mean variance optimization process. To use the method for portfolio construction, assuming there are 252 trading days in a year, I calculated the annualized covariance matrix using daily returns. This matrix reflects the common fluctuation between different companies and their individual risk volatility. As seen in the diagonal in the figure 12, this matrix will be used for calculating for the Sharpe ratio and utility. By using 10,000 different portfolio weights, I obtain 10,000 different returns and volatility results under both Sharpe ratios and utility methods. For this calculation, the results S and U show the higher returns are better given a specific level of risk. The difference is that utility incorporates a risk aversion parameter A. The larger the value of the A, the higher the aversion to the risk. As shown in Figure 13, the red dashed line represents the efficient frontier. Points on this line indicates the maximum return that can be achieved from given a level of risk. Therefore, under the given risk condition, the maximum return for the Sharpe ratio and utility methods are 0.226 and 0.23 respectively. Based on the optimal weight for the Sharpe ratio and utility portfolio as shown in Table 3, I test them on the test set. The performance displayed in the Figure 14 reveals that both portfolios often lag behind the equal weight portfolio for a considerable period. This is mainly due to the news shown in the lower right corner. In 2022, the US dollar interest rate surged, leading to a substantial decline in the largest investment, Microsoft, which only began to recover profitability by the end of July 2023. Next, Task 3 involves using PCA to construct a portfolio. This task aims to use PCA to construct a portfolio using all stocks from February 2004 to December 2023. I use 80% of the data as training dataset. First, I calculate the returns covariance matrix, which reveals stock correlation. For example, Apple and Microsoft have the highest correlation. I extracted the top 10 principal components from the covariance matrix, which capture the most variance in the stock returns. These components reveal different degrees of explanatory power, with the ability decreasing. Principal component 0 reflect the overall trend in all stocks movements. Using different principal components to calculate the portfolio, I selected the top 3 portfolios based on the Sharpe ratio. The heat map visualization of the weight allocation shows that portfolios 7 and 8 have a high allocation to Apple. Testing the selected portfolio on the test set, as shown in Figure 15, we found that portfolio 8, green line, has the best return, with portfolio 7 also performing well. Their high allocation to Apple contributed to these good returns. Task 4 is hierarchical risk parity. This task uses hierarchical clustering to optimize the portfolio by clustering all stocks. I use 20 years of data with 80% for training and 20% for testing. First, I calculate the correlation matrix, then use the word method to quantify distance and calculate the linkage. The dendrogram in the Figure 16 shows the clustering results, where tech companies clustered together in green section. Next, I perform quantile diagonalization based on the clustering results to arrange similar assets adjacent to each other in the covariance matrix. As shown in Figure 17, the circle area highlights a square with a similar color shade, indicating the clustering of technology stocks. Then, I perform recursive bisection to divide the cluster into 2 subclusters. I calculate the variance of each subcluster and adjust the weights based on the variance of ratio. The final weight comparison is shown in Figure 18. Using the obtained weight allocation, I test the results on the out-of-sample data. Despite the drop in 2020 due to the pandemic, the overall performance was profitable. The final Sharpe ratio on the out-of-sample data reached 0.497. In conclusion, this presentation has covered 4 different machine learning methods for constructing and optimizing investment portfolio. That's all. Thank you for your attention.